Recent survey data from South Korea has illuminated a significant trend among the country's wealthiest individuals, suggesting a growing inclination to relocate internationally. This development, often framed in dramatic terms, is directly linked to the nation's inheritance tax regime, which is among the most stringent in the world. This situation provides a compelling case study for examining the complex interplay between national tax policy, capital mobility, and the behavior of high-net-worth individuals within the global financial system. The potential for capital flight and the relocation of economic activity raises fundamental questions about how governments balance the objectives of wealth redistribution with the need to maintain a competitive and attractive domestic economic environment. The core issue revolves around South Korea's inheritance and gift tax law, a system designed to address wealth concentration and generate state revenue. The policy structure and high marginal rates create a substantial financial liability for the inheritors of large estates, particularly those involving control of family-owned conglomerates, or chaebol, which have historically been central to the country's economic architecture. This tax framework, while rooted in specific socioeconomic goals, is now interacting with a globalized financial landscape, where capital and individuals are more mobile than ever before. The resulting tension highlights the systemic challenges that arise when a domestic policy designed for one purpose produces unintended consequences in a different, more interconnected context. Understanding why this system persists and its operational effects is crucial to grasping the economic logic behind the current dynamic, and the potential responses it may trigger from both private actors and the state. At the heart of this issue is South Korea's progressive inheritance tax system. The statutory rates are among the highest in the developed world, with a top marginal rate of 50% applied to the total value of inherited assets. This rate is already substantial when compared to other major economies. For instance, the United States federal estate tax features a top rate of 40%, while Germany's is capped at 30%. Japan's top rate is 55%, but various exemptions and deductions can often reduce the effective rate. What makes the South Korean system particularly severe is an additional surcharge applied to the transfer of controlling shares in large corporations. When a majority stake in a family-owned business is passed down, an extra premium can be levied, potentially pushing the total effective tax rate to as high as 60%. This specific provision directly targets the chaebol structure, a cornerstone of the South Korean economy for decades. The historical context for this policy is rooted in the post-war development of South Korea. The government actively supported the growth of large family-controlled industrial conglomerates as a strategy for rapid industrialization and export-led growth. While this model proved highly successful in driving economic expansion, it also led to significant concentrations of economic power and wealth within a small number of families. The high inheritance tax was subsequently institutionalized as a mechanism to mitigate the perpetuation of this wealth concentration across generations and to ensure that a portion of this accumulated value was returned to the public purse. The policy was intended to function as a tool for promoting social equity and reducing the pronounced wealth inequality that had emerged alongside rapid economic development. In practice, however, this system now imposes a formidable financial burden on the continuity of family-owned enterprises, forcing them to navigate complex and costly succession processes. In real-world conditions, this tax system creates significant operational challenges for the country's largest economic entities. The transfer of a controlling interest in a multi-billion-dollar corporation from one generation to the next triggers a massive tax liability that is often due in a relatively short period. Families faced with a tax bill amounting to more than half the value of their shares have limited options for payment. One common method is to sell a portion of their stake in the company on the open market to raise the necessary cash. This can dilute the family's control over the enterprise they've built, potentially exposing the company to hostile takeovers or pressure from activist investors who may not share the long-term vision of the founding family. Another option is to take out substantial personal loans, placing the family under immense financial strain. In some high-profile cases, inheritors have had to commit to paying their inheritance tax bill in installments over a period of several years, a process that can impact their personal finances and the strategic direction of the company. These pressures are a direct consequence of a tax policy that, while aimed at redistribution, directly affects the governance and stability of the nation's primary economic engines. The potential for a significant outflow of capital and human talent represents a systemic risk for the South Korean economy. The phenomenon of tax refugees, where high-net-worth individuals and their families relocate to jurisdictions with more favorable tax regimes, is not unique to South Korea. However, the scale suggested by recent surveys indicates a particularly acute level of dissatisfaction. Should a substantial number of these individuals act on this inclination, the consequences could be multifaceted. The most immediate effect would be capital outflow. This would not necessarily manifest as a sudden dramatic exodus of funds, but rather as a gradual, strategic relocation of assets, investments, and corporate headquarters. Wealthy families might establish holding companies or trusts in jurisdictions like Singapore or parts of Europe with no or low inheritance taxes. Over time, the operational center of gravity for their business empires could shift abroad. Following the locus of family control, this would translate into a long-term erosion of South Korea's domestic tax base, as corporate and personal income taxes associated with these enterprises and individuals are redirected elsewhere. Furthermore, a brain drain of entrepreneurial and managerial talent could accompany this capital flight. The founders and inheritors of these large corporations are not just passive capital holders. They are often deeply involved in the strategic management and innovation that drives their businesses. Their departure would mean the loss of invaluable institutional knowledge and leadership. This could, in turn, reduce the global competitiveness of South Korean corporations. If these companies face a persistently higher cost of capital and succession compared to their international rivals in the United States, Europe, or even other parts of Asia, their ability to invest in research and development, expand into new markets, and attract top talent could be diminished. The institutional pressure created by the tax system may therefore inadvertently weaken the very economic pillars it seeks to tax. This creates a feedback loop where a policy designed to capture a share of existing wealth may end up shrinking the future wealth-generating capacity of the national economy. The social fabric could also be affected, as a visible exodus of the wealthy could deepen public perceptions of inequality and unfairness, potentially leading to social friction and political pressure for policy reform from various sides of the spectrum. To understand how these dynamics operate in a real-world scenario, consider the hypothetical case of a major, publicly listed South Korean technology conglomerate following the death of its founder and chairman. The founder's heir is set to inherit a controlling stake valued at several $billion. The inheritance tax liability is calculated to be approximately 60% of this value, amounting to a multi-billion-dollar tax bill. Upon the announcement of the chairman's passing, financial markets would immediately begin to price in the succession risk. The company's stock price may experience volatility as investors anticipate the methods the heir will use to pay the tax. The heir's primary options are to sell a significant block of shares, take on massive personal debt, or use company dividends, if sufficient, over an extended payment period. If the heir chooses to sell shares, this sudden increase in supply on the market could depress the stock price. Institutional investors, including sovereign wealth funds and private equity firms, might see this as an opportunity to acquire a strategic stake in a leading Korean company, potentially altering its control structure. The family's diminished ownership percentage could make the company more vulnerable to shareholder activism aimed at extracting short-term value, possibly at the expense of long-term strategic investment. The policy response from the government would be to collect the tax revenue as mandated by law. Regulatory bodies like the Financial Services Commission would monitor the market's reaction to ensure orderly trading and transparency in any large share transactions. Meanwhile, credit rating agencies would assess the impact of the ownership changes in any new debt taken on by the family on the conglomerate's overall creditworthiness. This entire process demonstrates how a domestic tax policy directly triggers a series of actions and reactions within the global financial system, involving capital flows, institutional behavior, and the transfer of risk and control, all without any direct government intervention beyond the initial tax assessment. If you value calm, systems-level analysis of global finance and geopolitics, please like, comment, and subscribe.